Welcome to Bloomberg ETF IQ. I'm Isabel Lee. Scarlet Flu is off this week on a well-deserved break. Let's go to the biggest stories right now in the nearly $22 trillion global ETF industry. The recent hack of cold Bitcoin wallets sends shockwaves in the crypto industry, with the number of hacks jumping in 2026. Some of the ETF issuers are seeing this as an opportunity. And in just a moment, we will speak with John Maier, Chief ETF Strategist at JPMorgan Asset Management. He discusses why active funds continue to concentrate in AI. And later, Eduardo Repetto, CIO of Avantis Investors, joins us. His ETF, DUNK, is soaring high marks. As always, Eric Balchunas from Bloomberg Intelligence is with us. This is the Eric on this Monday morning, and he's looking at flows. Eric, what do you got?
Isabel, thank you very much. Look, the flows are, again, pretty bullish, rather. You get the Qs at the top here. That's obviously very good to see, right? This is the Nasdaq 100 ETF with almost 10 billion. Then you've got VU here. So you have, the sort of retail trade and the traders together. Now, TLT is interesting. This is the long end of the curve. They call it the Widowmaker. It's lured many sailors to shipwreck in the past because if it works, it really works. But in order for this to go up, you'd have to have rates to go down, and this would shoot up. We'll see if this works. SGov, this is the more traditional bond play. This is basically cash. You get 3.8, 3.9%, but basically an NAV that barely moves. People like that as opposed to longer dated areas. And then you've got IVV, SPY-M. Again, a lot of S&P 500 and a lot of Qs. It's pretty good if you're a bull. Let's look at the outflows here. You do see SPY at the top, so some money out of here. Now, IEF, I think that was related to TLT. I think somebody did a trade down the curve. Can't prove it, but probably. That's the middle of the curve. And then SOX and SMH. I told you guys last week this would happen. When the semis went down a lot of the traders pile in. That's their sign to pile in. It rebounded, and I said we'll probably see them take profits, and they did. Same with XLK and AIEQ. And look at PAVE on here. Not sure why people pulling out of infrastructure. Who knows? Maybe they're going to something more growthy. Let's look here at the July flows. Now, we're into August, a couple days here, but July was interesting. It was a rough month. It definitely felt bad, even though the S&P was about flat. I mean, it didn't go down, but it felt like a very bad month relative to the rest of the year. But guess what? ETF flows unperturbed. So here you have equity, right? And this is fixed income. So it just looks like an average month for flows. I mean, again, this is so much bigger than the world we used to know. ETFs taking about double the money that they used to. But you can see here, everything taking in money, Isabel, because people were just buying the dip, both the traders and the long-term buy and holders, and that's why you have average flows on a not very average month.
Eric, July was definitely a blockbuster month, and we are here to talk more about it. Thank you, Eric. And joining our conversation now is John Maier, Chief ETF Strategist at JPMorgan Asset Management. John, thank you for joining us on this Monday in studio, in person. It's always a delight.
Thanks for having me.
To Eric's point, July was really a blockbuster. We saw active ETFs rake in $58 billion, and I think the milestone was pushed to $2 trillion. This is definitely a big deal, and it really signals that maybe this once niche investment product is now becoming mainstream. Talk to us more about how active ETFs have grown in the past years.
Yeah, I think it's absolutely active ETFs are mainstream. They're 86% of all of the launches. You certainly see JPMorgan as well as some of our competitors actively going into the space, no pun intended. And what I find most interesting is that you're starting to see, and this has probably helped driving the flows, a lot of these active ETFs are being put into models. And models really drive assets and help explode the overall flows. Because if you think about it, clients who are long-term investors, who are 3, 5, 10, 30 years, they want to be invested in a strategy that's going to earn them wealth and not be subject to kind of the quick ups and downs of the marketplace.
What about active fixed income ETFs? They're growing roughly twice their rate of passive, and they're capturing around 40% of the flows. Do you see more demand between active fixed income versus active equity?
Well, overall, flows for active are roughly 37 to 40%. So fixed income is slightly higher. We're starting with a smaller base. Now, the overall active market, fixed income is largely an active market, whether it be ETFs or mutual funds or SMAs. So probably 75% of the overall market is active. So thinking about how do you outperform with the ETF structure, you have a better structure. Why not put these into models? Why not? For example, we just converted an ETF, JPRF. It's a preferred fund. It typically outperforms its passive peers. It has a 4.8% duration, JPRF. I think people are going to buy this all day long as part of their extended fixed income allocation. Makes sense to me. You have more product.
Okay, when I think about bonds today in this environment, I relate to the people going to money market mutual funds and SGov, which is T-bills, because you have no risk, really, and you have 3.8% yield. Until that goes lower, why not? You're saying active fixed income, and I know people are buying these. What would be how would you sell me out of this more stable cash position into something that's active when we have seen that the ag and other bond ETFs has not hedged stocks when there's a downturn?
Yeah, and that's a fair point. And you brought it up earlier about the Widowmaker, TLT. Yeah, there's been flows there, but that's the long end of the curve. I think the intermediate and slightly below intermediate portion of the curve is where it makes most sense. And when you have an active manager, you can manage duration. So like JPRF, what I just talked about, has a 4.8 duration, whereas some of the other preferred funds have a higher duration. So you're bringing down your duration in that instance. If you're looking at other fixed income, you can manage that duration, where in a passive instrument, you really can't.
Let's talk about bond managers versus stock pickers, because David Cohen on my team, he puts the mutual fund flows out every month. It's the same story. Stock pickers, total outflows every month, big time. Everyone else kind of treading water, taking in cash. Are bond managers just lucky to play against a inferior index like the ag versus the stock pickers who have to play against the S&P, which is full of momentum? Or are they really just better?
Well, in our business, hope is not really a strategy. Luck, I guess some people have it. But fixed income is typically, and it's ingrained in us institutionally, that it's part of our overall allocation, whether you agree with it or not. So when you have an instrument that's cheaper, and it's going to immediately help you outperform. If you're going to access 50% of the outside of the ag that's not in the ag, you have the ability to outperform the securitized portion of the market, other portions of the MBS or the ABS market. So an active manager, I'm not going to say it's easier, because our portfolio managers would not agree with me that it's easier, but the odds are higher that you're going to outperform.
I want to talk about models. Eric and I earlier in the call, we said John Maier is the guy to ask because he had models in his career. ETFs make up around 55% of model portfolio allocations. Talk to us about how maybe financial advisors are using ETFs as a shift in how they allocate assets. Is this becoming the new norm? Similarly, we always talk about in the team that distribution is the hard part when it comes to ETFs, but some are like, I just want to get into a big model and that'll help me already. Well,
distribution for models is actually pretty difficult, and the assets tend to be sticky in models. Building a model business is not easy. Selling an ETF for a financial advisor is probably a lot easier, but if they sell the entire model, it's stickier assets over time. Now, I started with models when I was at Merrill. Those grew because they were open architecture. I think everybody likes to kind of see different parts of the universe and not stick to one company, and I think that's where you see a lot of success. Some of our competitors are, just proprietary, and they may have the right ETFs, but really most don't. So that's why looking at an open architecture, I think, makes a lot of sense. Putting whether it be passive or active into a model and adjusting, whether it be quarterly or monthly, you're getting institutional investing, made for retail, and I think that's only going to grow as the advisor community shrinks, and you have a scalable solution like models.
You put thematics in your notes here. You used to work at Global X, and they big in thematics. JPMorgan doesn't do a ton of that. Thematic ETFs are now up to, I think, 160 billion or something. They've had kind of a renaissance. Yeah. And I want to get your take on those. They seem to me like they're a good complement to a cheap beta or cheap active core, and you can participate in areas that are a little younger and the stocks aren't in the index yet.
Yeah.
So what's wrong with that?
I don't think there's anything wrong with it. And you love to talk about hot sauce, Eric. So it's like I would think thematics are hot sauce, but if you really break down what thematics are, and also like photonics. Do you even know what photonics are? I'm just
recently
I've
learned what it is. Yes.
I had to Google it the other day. I'm like, I think I got it.
I have to Google every fourth ETF file. Yeah, it's crazy. That's why I like doing it, though.
Yeah, it's fun. It's fun. Yes, every day is a new day.
But thematics. It changes over time. So like electric vehicles, 6 or 7 years ago is kind of ingrained in like the broad indexes today. So in terms of thematic investing, we at JPMorgan do thematic investing, but it's built into kind of our growth allocations or our technology allocations, and an active manager gets to select what's inside or what the specific company they're going to use and look at those companies based on fundamentals and valuation versus being in an index that is, somewhat arbitrary in terms of kind of creating the rules to encapsulate these companies to put in those indexes. So sure, people love to get into the latest FOMO trade. The people who get in early often are beneficiaries of that trade, as we've seen recently.
Speaking of FOMO and hot sauce, which Eric, I think you should really trademark. You should really work on trademarking.
Well, it's a pretty universal term, but
I'm
with you. I need to make money on this somehow.
Yes, you do. Talk to us about your thoughts just in general on leverage ETFs. I mean, they've taken the world by storm. It used to be that it's only me and Eric and a couple of us obsessed about leverage ETFs, but now even the so-called mainstream are concerned because it has been moving markets.
Well, levered ETFs are roughly $200 billion,
yes.
And the single stocks are about $50 billion.
Would you ever wade into that space?
JPMorgan, that's not really part of our DNA. But it's certainly, the great thing about the ETF structure, and if it falls into 60-11 or the ETF rule, you can do a lot of things, and the SEC allows for it. There are people who like to trade, and those products may be appropriate for them. I just hope they understand the risks that are involved, that they're only getting the return of an index geared for one day. And the average holding period, and I can't quantify this, is probably 4 days.
Yeah,
so it's fast money. I think I saw Eric talking about it on another podcast, that it's like money machines for some folks.
ATM machines.
ATM.
And
well,
another trademark.
These semi-leveraged people they've made, honestly, 40, 50 billion.
It's incredible.
Yeah.
Yes.
So I think there's a misconception that they're all just getting hosed. I think the reason they're so popular is they are making money. But to your point, you got to trade them. You don't want to hold them because weird things happen.
And you just have to be educated.
Yeah, because of the effects of compounding, you're not going to get what you expect over a long period of time, particularly in a chopping market. Like in a trending market, you'll get fairly close, but you are buying leverage. So understand what you're buying is kind of what I always say.
Definitely understand what you're buying. John, such a delight. Thank you for joining us in studio. Thanks to John Maier of JPMorgan Asset Management. Coming up, hackers stealing millions in Bitcoin from cold wallets. Bitcoin ETF issuers seeing this as another reason for investors to favor institutional players. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Isabel Lee. Time now for ETF Brief, where we highlight stories and trends that caught my eye. So first is active ETFs. They raked in $58 billion last month, pushing the segment above $2 trillion for the first time ever. So these funds have garnered $457 billion so far this year and are on pace for roughly $800 billion in annual inflows, which obviously would be a record. That's a lot of numbers, but the important thing is that you know that this is a big deal and this is definitely historic. And up next, gold. It's glowing again. Investors are piling back in with a gold ETF call spew spiking last week. That came as gold rebounded to $4,000 an ounce. And I want to end with a CoinKite cold wallet hack. So I know this is crypto, but this is definitely related to ETFs. So the ordeal has so far cost an estimated $130 million in losses to an unknown number of customers. Outside of that incident, the first half of 2026 has already seen more and more hacking incidents than compared to recent years. So let's talk more about that issue with none other than Robert Mitchnick, or Robbie, Global Head of Digital Assets at BlackRock. Robbie, thank you so much for joining us. It's such a delight to have you in person.
Great to see you. Eric, how are you?
Eric is dying. He has a question to ask about.
Yeah, well, no, I have a prop. That's why I wanted to go first.
Okay.
So
you will definitely.
This right here is a wallet. This is a cold storage wallet. It's not connected to the internet at all. This was hacked. That's why this has rattled the faithful so much. Normally, a hot wallet is hacked, where you're connected to the internet.
Right.
This is sitting here, supposed to be in the safest possible spot, and they got 135 million so far from like 5,000 different accounts or something. And this has shaken the very core of what cold storage is supposed to be. I premise this is probably pretty good news for ETF issuers, because you're like, well, we are bigger. This is a company that had 5 employees in Canada. Something was wrong with the code.
Yep.
Anyway, how are you looking at this? And have you been talking to clients about, hey, come over to BlackRock, we won't mess up your Bitcoin?
Yeah, well, unfortunately, with that incident, it was a fairly sort of simple amateurish error that led to the vulnerability. I think that's important for people to know. And you had the graphic up about the rising number of crypto hacks. I think what's also important to recognize is that that is not a breach of Bitcoin or any other crypto protocol. Those are individual security mismanagement issues that happen from various individuals or providers, right? And so I think that what we've seen, frankly, since the start of the Bitcoin ETFs being available in January of 2 years ago was an overwhelming demand to be able to hold in a very simple turnkey trusted vehicle and not have to worry about all the unique elements of Bitcoin and crypto security that generally custody otherwise would require of an investor.
So we've definitely seen the blockbuster launch of Bitcoin ETFs, although we've seen last week Hashdex liquidate one of the ETFs. I mean, someone had to throw in the towel maybe. But more broadly speaking, we've seen the evolution of the Bitcoin ETFs. How important are creation and redemptions in kind, especially when it comes to the Bitcoin ETF ecosystem? I know BlackRock has done it. We wrote an article last week. I'm wondering how much of your inflows, how much of that, the percentage, is an in-kind Bitcoin creation.
It's still a minority. More of it is new dollars coming in, but we've seen the amount of in-kind activity be a growing number over the 3 quarters now that's been allowed. And we've been working quite hard to help bring the minimum down because there's interest in this from investors of all sizes. When we first started, 25 million was the minimum that you needed to be able to do one of these in-kind conversions. Now that's come all the way down to around 1 million, and hopefully one day it'll be accessible at any size. That's our hope. And so that's been great progress.
Why is it so expensive?
Well, it's about the size, right? So there's some manualness to the transaction that needs to be undertaken, and so it's about what providers are willing to support just to make the math and the administrative process work.
So just to be clear, so if you're an early Bitcoin holder, you had some in a cold wallet, and maybe you want to move some over to BlackRock, if you have $1 million in Bitcoin, you can just give it to BlackRock through an AP or a third party, and you'll get IBIT shares in return, and that's like a tax-free transaction.
Yeah, so everything is intermediated, as you said, by an authorized participant. So that's the key. We actually don't have the ability to support that directly to investors, but there are a number of participants in the ecosystem who've stepped up and who have been facilitating that for investors, and their willingness to do it at smaller and smaller sizes has been a really positive development.
I agree with you, and also that point about this whole hack wasn't Bitcoin network, it was an intermediary. All the problems with Bitcoin are the intermediaries. That's why I think ETFs showed up. It's like, okay, hey, the adults are here. We're not going to mess this up. And so far, the ETFs have done a good job. Now, Bitcoin has come down, and the ETFs track the price of Bitcoin going down. And there are a lot of people who came in maybe at 100,000 or 110. They're underwater. You're probably the guy who gets the phone calls. You're probably the guy who has to talk to them if they're like, hey, what's going on here? How is that going? How committed are they? Or are they starting to get shaky now that we've been around 65 for a while?
Well, what we've seen consistently through these 2.5 years is that the ETF investor base tends to be more of a fundamental long-term buy and hold type segment. And that's continued to be exhibited through this downturn. And everybody who comes into Bitcoin hopefully understands that it's a volatile asset. It's always been a volatile asset, right? There have been now 5 major boom and bust cycles. Each time the cycle ends significantly higher than the prior one, but with a bumpy ride along the way. And so it's been the case in this one as well. So I think that we've seen sentiment turn in a noticeable but subtle way the last month or so. You've seen Bitcoin decouple from equities starting earlier in the year. For a while, that was hurting Bitcoin because equities, particularly AI, were roaring, and Bitcoin was kind of flat to down. Then in July, when AI had the huge pullback, Bitcoin outperformed significantly. That decoupling is healthy because it's part of the thesis for a lot of people around Bitcoin as a diversifier and potentially a hedge against some of the left tail risks that exist elsewhere in the portfolio.
You've also recently launched your Bitcoin Premium Income ETF. Talk to us about that, and why would an investor want I guess they would want income. But like, how big can that market be compared to just holding spot Bitcoin directly in maybe 45 seconds?
Yeah, so BITA has been off to a solid start. We've seen quite a bit of interest. Obviously, it's not going to be massive out of the gate in the same way flagship products like IBIT, ETH-A, ETH-B have been. But it's solid, and it's really investors who are looking to make a little bit of a trade of saying, I'm going to give up a tiny bit of the upside in Bitcoin in exchange for a mid to high teens target yield, dampen the volatility a little bit, dampen the downside risk. And so that's going to be a slow build that we've seen promising demand for.
Slow build, but at least we're getting there, and there's definitely interest. Thank you so much for joining us on set, Robbie Mitchnick of BlackRock. And also a reminder that you can listen to Eric and Joel Weber on Trillions, which I must say is a very fun podcast. It's their podcast that covers the industry, the launch, closures, filings, just industry, and more. This is Bloomberg. It's time to take a look at Bloomberg Intelligence traffic light system, which ranks ETFs by risk levels. Green light means low risk, yellow light means moderate risk, and red light means high risk. Eric, what do you got?
Today we got Dunk, great ticker, Dana Unconstrained Equity ETF. Nothing too special except that it's active, so it gets one ding for that. And the reason we ding active is because some of these can be concentrated. This has only 24 stocks, so it's very volatile. But interesting fund, and that's why it gets a green light, but with one warning.
Amazing. You can look more at our traffic light system on BI ETF Go. This is Bloomberg ETF IQ. I'm Isabel Lee. It's time for today's drill down, where we focus on one ETF. Eric.
Isabel, today we are looking at AVUV. This is the Avantis US Small Cap Value ETF. This is an amazing ETF. Small cap value is sort of the opposite end of large cap growth. We've been in a large cap growth era for 5-10 years at this point, even longer really. And yet this ETF has gotten to be $30 billion. How is that possible, right? A couple of reasons. One, the performance, which we'll look at in a minute. Two, the fee. It's only 25 bips for active. What does it do? It looks at small caps, but it has a factor mindset. It basically looks for value and size factor, right? And then it has a profitability screen so you don't get like value traps. That's the general idea here. Let's look at the cross section of holdings. And what's interesting here, I thought, okay, maybe this thing's cheating up into mid caps or tech. It just basically has a lot of sort of like value-ish kind of sectors here. There are no mid caps. And if anything, it's leaning into energy and real estate, which again, haven't really been that in favor. So again, kind of a minor miracle that this thing, and now we'll show the returns, was able to go up 88% in 5 years. That is extraordinary considering this is the Vanguard Small Cap Value Index Fund. It only returned 55%. That is a lot of outperformance. And then even worse is IWM, the big small cap ETF, was only up 44%. So you're doubling small caps by picking small caps. This is exactly why the dream of active will never die, because you have funds like this once in a while. It almost performed as much as the S&P as well. So again, you lay down performance like this, you can buck the trend and find assets in a category that really nobody was looking at until this thing came around.
Thank you, Eric. That's definitely interesting, especially when it comes to the small cap space. And joining us now to talk more about that is Eduardo Repetto. He's CIO of Avantis Investors. Eduardo, thank you so much for joining us on this Monday. Your original 5 ETFs have turned 7 and will turn 7 in September. But I want to talk about the ETF that Eric just mentioned, the small cap one. What has made it so successful, and what can your other ETFs and the broader ecosystem learn from that?
Thank you for having me. It's always a pleasure. It's always a pleasure speaking with you and Eric again. Look, what we're doing is basically the universe of a small cap is full of companies that make no money. But we're looking for companies that make decent amount of money, but they also have good balance sheet and low price. If you focus on companies that have good balance sheet, good cash flows, and low price, you should get outperformance. And we do that in a very diversified way, managed on a daily basis, as an active ETF that Eric just mentioned. And that has paid off. And it's not this a one-hit wonder. If you look at our international version of this ETF, the same story, performing extremely well. And so we are thankful for you guys to looking into us and also our clients.
So, Eduardo, I looked into this. I put it through Port. I've been trying to kick the tires on this. What's the secret? The only thing I could find is that when you look at a factor loading of this, you have more value than the index and you have more size than the index. Well, that would make sense, your small cap value, but the index is also small cap value. Then I looked, you weight by the factor score. And I think that might be the difference, is that you're not only screening by these factors, but you're weighting by them. Am I onto something here, or is there something else going on?
So you have a point here. So whenever we select securities, quality is also a factor there if you want to think about that, because we're really looking for companies that have high quality and also very, very value-like. Value by itself, low price to book, for example, really doesn't give you anything. You may finish with companies that have low price to book and bad earnings. That's not attractive to us. We want companies that have low price to book, but also have quality characteristics. So you're buying something at a bigger discount, way more attractive. And once we select those companies, you're right. You are not just doing a market cap weighted portfolio. We're emphasizing the more that are more attractive because some have better characteristics than others. Remember, this is a very well-diversified portfolio, more than 700 names. So all of them are attractive, but some are even more attractive than others, and those have a little bit of emphasis.
And you've argued that investors don't need concentrated portfolios to generate excess return, and this ETF is emblematic of that. And with so much of the market's gains just concentrated in a handful of ETFs, talk to us about how diversification is actually helping your performance. And I know nearly every fund manager says diversification is key, but I think in this time, it's actually working.
Well, you're making a great point. So people would used to think you want value added, you have to be concentrated. You want outperformance, you have to be concentrated. Our strategies are just the opposite. ABUV, 700 names, and around 4.5% value added since inception. But if you look at our emerging markets ETF, 3,000 names and around 2% outperformance since inception 7 years ago. So you can get diversification and value added. And that's what we are about at the end of the day, minimizing the necessary risk and provide value added at good expense ratios, like Eric said at the beginning.
Your background is interesting to me and impressive. You have a PhD in aeronautics from Caltech. You won a bunch of awards. Obviously, I'm assuming you're applying this to the investment strategy. So is there anything about aeronautics that actually helps you as an active manager?
Well, look, when you do a PhD, basically what you're trying to do is go to the cutting edge of science and advance it a little bit more. So my PhD, I have amazing advisors, I have an amazing place to study, and I was very lucky because I was able to understand how to create theoretical models trying to reflect reality and then try to solve those models with computers. And when you're thinking about investment, that's more or less what we do. We're trying to understand how to put a theoretical model, how a stock should behave, and then using computers to create better portfolios.
You make it sound like it was very easy, but I'm sure Eric and I could probably never do it, even if we try. But Avantis sits between traditional active management and index investing. Do you think we're moving towards a world or an industry where that distinction matters a bit less, where investors may want a systematic strategy that really can outperform in the long term?
Look, we just saw over the last several years several flaws in indices. We know about indices having index reconstitution effect when everyone is trying to buy everything at the same time. You imagine, I want to buy your house, everyone wants to buy your house, the price of your house goes up. The same is happening with an index rebalancing. But we saw more. Remember all this debacle that we have with all these new IPOs and the index trying to change the rules in order to include an IPO? So indices have flaws, have benefits. The benefit of indices is that well diversified, very low fees. What we are doing is trying to have all the benefits of indices, low fees, diversification, but having a layer of let's call it active management, managing the portfolios on a daily basis, considering valuations on a daily basis, because that should be add value. You should not think that buying a portfolio once a year and holding it for 12 months is a good strategy. You have to be on top of these portfolios every day because we saw as GameStop. Stocks change on a daily basis. You have to manage a portfolio on a daily basis.
So when you look at this fund, it's clear that factor investing works, right? But factor investing was like a huge rage in the ETFs about 10 years ago. We all called it smart beta. It took in a ton of money. And then people were like, well, maybe the factors go away if too many people do it, right? And the premium goes away. Is that true? Is factor investing maybe a little more doable in smaller or international areas versus, say, large caps?
That's a great question, Eric. The crowdiness is important. But remember, what we have been doing is trying to use all the learnings of factor investing on asset pricing models and putting back into evaluation framework. We're really working with valuations of companies. And evaluation, what companies we like, good balance sheet, good cash flows, and low price. As long as you focus on something that is more holistic than a particular factor, I think that you are fine. But you're asking, does it work in US large caps? Look, we have a ticker, AVLC, Avantis Large Cap. It's benchmark Russell 1000. Performance is really good, 1.5% a year above the benchmark. So it works in small caps, it works in large caps, it works in international if you do it right. And we think we're doing right. Are we perfect? No, perfection is never achievable, but we try to move towards that. We always try to improve, and that's a goal.
And you're now seeing assets come from more than 60 countries globally, and as Avantis really continues to expand, where do you see the most opportunity? It could be a region or a specific country, anything that could break the news here on ETF IQ.
That's a great question. Look, we are a service company. We love to provide investment services to anyone that wants to invest with us at the end of the day. And we are very simple in how we explain what we do. We want people to understand it. And so now we have UCITS ETF. We have a strategic alliance with CIBC in Canada, where we have 8 ETF. We're going to have 3 more. We'll have 3 ETF in Australia that we just started, and we are probably going to add more. So look, we're here to help investors. And we get excited about being able to help.
All right. Thank you so much, Eduardo, joining us live from LA, Eduardo Repetto of Avantis. And you can read about this drill down, plus the latest in the ETF industry when you subscribe to the weekly ETF IQ newsletter, which I heard is a great newsletter. Coming up, investors still looking to tap into the AI infrastructure trade are turning to an emerging ETF category, Photonics. Mayuranki, VP of ETF Trade Strategy at Raymond James, will join us to discuss. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Isabel Lee. Now let's go through the ETF lifecycle from its initial filing to its final farewell. Let's start with filings. Trader filed for 18 new single stock leverage ETFs that are either 2x long or 2x short. The ETFs include stocks from sectors including tech, quantum computing, space, software, and semiconductors. This trend of single stock ETF launches and closures continues to show no signs of slowing. And step 2 is the launch. So Roundhill launched a pair of AI-related ETFs last week, the Roundhill Photonics and Optics ETF. The ticker is LYTE, and the Roundhill NeoCloud ETF, the ticker is NCLD. So it's too early to tell how successful they will be based on AUM or flows, but volume can often be an early indicator. And by that metric alone, LYTE, or should I say light, Eric? Maybe light is how we say it. They had a very strong start to its existence. And for some of the final stage of its farewell is Bitwise. It has liquidated a suite of options income strategy ETFs. 5 were focused on single name equities, and 1 was based on Ethereum. The equities were GameStop, Marathon, Coinbase, Circle, and Strategy. The AI trade is definitely broadening compute into the infrastructure needed to move data. And in response, we have a new ETF category catching investors' attention, and that is none other than Photonics, which Eric and I Googled just like maybe a couple of weeks ago. So this focuses on optical networking, lasers, and data center connectivity. Mayuranki, or May, Vice President of ETF Trade Strategy at Raymond James, is going to tell us more. So Photonics, Eric and I have been going on and on about Photonics.
You said a few days, try a few minutes.
Excuse me, I looked it up a couple of weeks ago. Tell us about it, and is this the new theme? I mean, is this a sign that the AI trade is really broadening? I mean, we're going into photonics.
Well, as you guys might know, I work with a primarily institutional audience. So when we're looking at thematic ETFs, it's always from a little bit of a different lens. I'll start with light because it did just come out. And I think with the institutional client base, name goes for a lot, and knowing that Roundhill also launched DRAM, they were very excited about this potential new AI second derivative ETF launching. So we started getting inbound questions about Light, what it represents. Will it create increased liquidity in the names that kind of track the space? But zooming out from May until now, there's been 4 other ETFs that have launched within the Photonics category. So the interesting part there is that it's such a niche category that a lot of these names are overlapping across these funds. If you're looking at all these ETFs, you're going to see Coherent, Lumentum, and Sienna across all of these funds. So that's a lot of concentration in these names. And on top of that, Light bringing this extra attention to the category, we look to see if there's this uptick in AUM and flow, which August 7th was pretty good for laser specifically, but it's just a new center for them to focus in on, and now it just goes to show that there's new thematic niches that are arriving across the board.
Oh my God, yeah, they're coming out like crazy. By the way, you know who has another Photonics ETF? Our favorite issuer, Corgi.
Oh, really?
Yeah, that's their big hit, is the EUV, is the lithography and semiconductor photonics.
The more than 50%
they also have a 2x one too in the Photonics already.
And Roundhill just launched a 2x on themselves too. It's just getting so meta, isn't it? Let's go. If somebody's hearing this, and I've had people say this, like, I'm so over all this. This is all going to blow up. It's an AI bubble. So we actually looked at like which stocks or asset classes would be a good hedge if AI just goes away. So I focused on DRAM. And if you look, the 2 companies that have the most inverse correlation are the garbage companies, Waste Management and Republic, which kind of makes sense, right? Your AI is like a dream, and then you still got to pick up the trash. Okay, that's like the reality opposite.
Yeah. AI still can pick up the trash. Maybe a robot one day, but
maybe someday. But for now, it's more inversely correlated. Look at this. Then VIX and also bonds.
Incredible.
So what do you think of that? Do you have advisors at Raymond James who are like, I need to hedge this because this is going to get ugly?
Yeah, so we've definitely had some attention around waste management and garbage companies previously, not necessarily people looking at it in correlation to DRAM. But I'd say the space is just so small when it comes to ETF optionality there. EVX is the only one you would probably hedge towards if you wanted a pure play exposure. And so naturally what happens, unfortunately, with a lot of our institutional clients is that they'll go to the next best thing that has high liquidity in AUM. So they'll go to an XLI, an industrials name, and they'll hope that that gives you some level of hedge against it. But they're not going to put their money into an ETF that's getting virtually no inflows, even if it does target such an interesting and unique space.
All of this we're talking about, how much of this is real fundamental demand versus investors just simply looking for the next AI trade? And is valuation getting ahead of itself? Like, is Photonics going to be a thing to stay? Are Eric and I still going to be talking about Photonics next year?
So this, when it comes to the institutional client, this begins with, are they looking at it from the company to the ETF, or are they looking at it from the ETF down to the companies? If they have high conviction in some of the companies that even represent the space, they don't necessarily need high conviction in Photonics. They just need to believe in the company and hope that this extra attention does something that's great for them, specifically if they just hold Coherent, for example. But if they care about Photonics specifically, I think they're always looking ahead to see what's the next one. So I can get ahead of the game and join in when the space is so new and you're gaining a lot of especially retail investor attention.
20 seconds. Do you go into the equal weighted or do you stick to market cap weighted VU? I saw that in your notes. What's the move?
I would say that if you're looking at RSP, for example, the go-to equal weighted fund, and you juxtapose that with the MAGS, the Magnificent 7 ETF, you're seeing 10 percentage points of outperformance from RSP this year. But I think what's been interesting is from the advent of big tech earnings and also just the earnings season in general, you've seen this contrasting flow behavior between RSP and MAGS. And for some time, you were seeing MAGS was just lagging. But now it's gone to MAGS has August, I think about 400 and something million in AUM in inflows. And on the flip side, RSP has seen the same number in outflows. So it's always looking to see if we're seeing this reallocation and a tactical trade into big tech, or if it's just this temporary normalization and it goes back to RSP.
I call it, it's a movie we've seen before and it's a short film.
What is it?
The quick move to equal weighting. It
I
always
thought
lasts
you were
for a
going to
month.
answer and say, what is?
But
Everybody goes back to VU in the end.
That's true.
Thank you so much, Maydi of Raymond James, and you're sticking with us at ETF IQ coming up later this hour. Thank you so much. It's time now for the ETF IQ test, where we put our ETF knowledge to the test. Here is a sneak peek at one of the questions. There it is on your screen. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Isabel Lee. Now it's time for the most awaited program of the show, the IQ test. And with us is May D of Raymond James, and also John Maier of JPMorgan, and of course, the one and only Eric Balchunas was with me the whole hour. So we're going to have a test, and I'm going to be judging you if you get things wrong. So pressure's there. First question. The U.S. is the world's largest ETF market by trading volume. China is a distant second. Who's next? A, Canada, B, Hong Kong, C, UK, and D, South Korea. May?
That's tough between C and D, but I think I'm going to have to go UK just because of the UCITS ETF market.
Okay,
I don't remember what time frame, but I'm going to go South Korea because of the recent explosion.
Okay. John?
I'm going to go Canada.
Wow, all different.
Wow.
That's rare.
Okay. South Korea, Eric.
Didn't you create the questions, Eric?
No. Eric created the question. Okay. Eric scores 1. Up next, question number 2. So May and John, you have to catch up. Which Brazil-themed ETF has the most assets under management? FLBR, EWZ, Brazil, Brazil? May?
I'm going to have to go classic B, iShares Brazil ETF,
Okay.
EWZ.
I'll go C.
John?
I'm going to go B.
Okay.
Wow.
Let's see. B, who got that?
John did.
John. Okay.
It's the global
you
X.
So
got it
Eric
too.
won.
Sorry.
John
It's a
won.
global X.
Last question. Which ETF issuer has the most assets under management in Hong Kong? Hang Seng, CSOP, Maier, or iShares?
I'm going to have to go CSOP.
Okay. Eric?
I'm going to go CSOP.
John?
Same.
Oh, wow. Everyone follow the herd. Okay. What is the answer?
Yes.
Okay. So Eric got 2 points. May
We
got
all
1
got 2.
point.
I
John
got 2.
Oh, you got 2. Oh my gosh, it's a tie. Should we have a fourth? No, we don't have a fourth question. Okay, I guess everyone is a winner. Or maybe if I want to be mean, I'll say no one won. But congratulations, everyone. You got 2 each. That's got to be a record, Eric. I'm not sure. Is it?
No. Normally somebody wins. That is, I think this is the first.
Look at that.
Yeah. Good job.
Okay.
I say we give
You
it to
guys
me
did-
since I went first.
Thank you.
Yeah.
Don't forget
We will.
to catch Pointed at Bloomberg.com or at the QR code on your screen. This is Bloomberg.